Hello again, WSU Vancouver VITA volunteers. Welcome back. So up till now, we've spent our time learning about some basic things that we need to put into the return and things that we need to decide, like dependents and filing status. And then we went on to start compiling all the sources of income that need to get reported on an income tax return. And then in our last lesson, we moved beyond compiling income and we started talking about what kinds of expenses our taxpayers had that they would be able to deduct from that income so that those deductions wouldn't be taxable anymore. And then by the end of last time's lesson, we got to our adjusted gross income, which again is a really important line on the return because it helps us decide the eligibility of our taxpayers for so many credits. In this lesson, we're going to be moving on from the adjusted gross income, and we're going to talk about the standard deduction, and then we're going to find ourselves at the taxable income line, and then we're going to talk a little bit about the tax computation. So after we reach our adjusted gross income line, we have a kind of a split in the flow of how a return is going to go. And some people are going to be able to deduct the standard deduction, and some people are going to find that they get a better tax deal if they itemize their deductions. And here's what it looks like on the front face of the 1040. We have line 12A is standard deduction or itemized deduction. So it's important to recognize that this is an either-or decision. So they're either going to take the standard deduction or they're going to itemize deductions. For our training program, we're going to focus in on what's involved with the standard deduction, and that is because that is what is in scope for basic return preparers. If you would like to become an advanced return preparer and certify at that level, then it would be good to learn about how to itemize deductions. And again, this information comes from publication 4491, or you can use the Link and Learn lessons online to kind of self-teach that area. So our main things that are going to determine the amount of the standard deduction are going to be filing status, age, and blindness. And if you remember way back, I think it was our filing basics lesson where we talked about who is required to file a return, and we threw out some numbers that were thresholds for who needs to file. And if you'll remember back, I mentioned that those are also the numbers that are for the standard deduction. The standard deduction is not something that you will need to calculate manually. TAXSLAYER does the heavy lifting for us, but it is important to be familiar with the base numbers and also be familiar with the situations that can cause the standard deduction to be a little bit different. So when you go and look at the return after it's finished and you see a number that looks a little different than the base amount you were expecting, you'll be able to kind of figure out why that is and understand the mechanics of it. So I put together this chart. You can see here we have in our header the filing status, and of course we have our single or married filing separate, head of household, and married filing joint or qualifying widow or widower, which if you remember, qualifying widow or widower gives us the same tax benefits as married filing joint for an extra couple of years. So for each of these filing statuses, there's a base amount. So for single, you have $12,550 for 2021 returns. For head of household, they're going to get $18,800. And for married filing joint or qualifying widow or widower, we're going to get $25,100. Now, if the taxpayer is over the age of 65 and they're single or filing head of household, they get an extra $1,700 added to the base amount. You can see that for married filing joint, the added benefit is a little bit less. They get $1,350. But if they have another spouse that's also over the age of 65, they get a $1,350 times 2 added to the base amount. And again, for blindness, for single or married filing separate or for head of household, there is the added $1,700. And then for married filing joint or qualifying widow or widower, again, each spouse gets an added $1,350. So you can see that we have our base amounts, and then for age-related situations or for blindness, there are some additions, and whatever that comes to will be that taxpayer or taxpayers standard deduction. So a group of taxpayers that have a different standard deduction are our dependents. And there is a worksheet in Publication 4012, Tab F, that can help you figure out what their standard deduction will be. And again, TAXSLAYER, if we're entering things incorrectly and entering this return in as a dependent return, it will calculate for you the standard deduction, but it's going to look a little funny. And so, you know, when you look at that number on the return, you might go, whoa, that's a really weird number. So you'll know that it's because this person is a dependent. And the rule for dependents are they have a standard deduction that is their earned income plus $350 if it's not over the usual amounts. And then if all they have is unearned income, then their standard deduction is going to be really low. It's going to be $1,100. So with dependents, you can see numbers in that standard deduction line that look really different than the base amounts that you might have been expecting. Even though our focus is on the standard deduction, we still need to recognize our taxpayers who come in with items that could be itemized, and we need to be able to do a sort of a quick calculation to see if they would get a better deal if they did itemize, and then refer them either to an advanced preparer or another site that has advanced preparers that can help them with this. So when they come in and they have their intake form, Form 13614C, you look at Part 4, the expenses, and Question 4 is the question to hone in on. Do they have medical and dental expenses, taxes, mortgage interest, or charitable contributions? Those are our kind of big blocks of expenses that could be itemized, and what we're doing is we're adding these up and comparing them to what this person would get if they took the standard deduction. So for instance, if our taxpayer is single, can they get more deductions by itemizing than $12,550? So for medical and dental expenses, this one is kind of a tricky one to be able to meet the threshold, because they need to have spent over 7.5% of their income before we even start calculating their medical and dental expenses. This can happen most often when, say, somebody was on COBRA benefits, so they became unemployed and they chose to extend their medical coverage, and so they were paying 100% out of pocket for their medical coverage. Or, you know, if they had unfortunately, it happens a lot in years where people had really awful medical things happen, and of course they would have had a lot of medical expenses come up. So you don't see this too often, just because that threshold is quite high. It's quite a bit for somebody to spend 7.5% of their income on medical expenses. But you do sometimes see it. Another area is taxes. So these could include state and local taxes. So that could be sales tax or income tax. You can deduct one or the other, but not both. And then real estate taxes is another area. So this is generally, for our homeowners, if they're paying real estate taxes, those count towards the taxes paid. Property taxes also count, but it's important to note that particularly in Washington, the taxes that we pay on our cars for licensing and registration, that's not the kind of property tax that counts. And so we will not see a lot of property tax in our state that people would be able to deduct. So really focus in then, on state and local taxes. Again, because we're not doing organ returns, we're going to see sales tax. And it could be if they bought a car that they'll have really high sales tax. That's a possibility. Or real estate taxes. Another area where people are allowed to deduct is for interest. And this is most specifically mortgage interest. So again, this is something that is most often benefit for homeowners. So are they paying mortgage interest? And at least for this year, mortgage insurance premiums are still able to be included in that, but that is a provision that is set to expire and hasn't been renewed in the coming years. But it wouldn't be the first time that that's been the case, that it was set to expire and eventually got renewed. But for now, that's just for 2021. And then our last kind of big area is gifts to charity. So these can be cash donations or they can be non-cash donations. So it could be like when you take things to Goodwill. If hopefully our taxpayers are keeping track of the value of the items that they're taking, and then they can deduct those. But for VITA, if they're doing over $500 of those non-cash donations, that's going to be out of scope for VITA altogether. So it doesn't matter whether you're basic certified or advanced certified. If they're doing over $500 in donations of non-cash items, they're out of scope for us. And of course, if somebody is in a position where it looks like they are going to beat the standard deduction by itemizing, we need to make sure that that return is getting help from an advanced certified preparer. There are some taxpayers who are not eligible to claim the standard deduction, and there's a list in Publication 4012, Tab F. But the big one for us to remember is for married filing separate taxpayers. If the other spouse is itemizing, then they are effectively forced to itemize as well. They would not be eligible to claim the standard deduction. Even if our taxpayers are claiming the standard deduction for 2021, they can still deduct up to a certain amount of charitable contributions as long as they were paid in cash. This was something new that came in 2020, and it's been revised a little bit and expanded a little bit for 2021. So for our married filing joint clients, they will be able to claim up to $600 in cash contributions, even if they're taking the standard deduction. And for all the other filing statuses, they will be able to claim up to $300. Now, this does not require advanced certification. So if you are a basic preparer and our client is taking the standard deduction, but they also have some cash contributions, you can absolutely help them claim this deduction. You'll end up putting it in the screen that says itemized deductions is most likely where it'll be in TAXSLAYER, but you'll still be able to do that with basic certification. So I just wanted to point out where that is on the 1040, and you can see that's line 12B, charitable contributions if you take the standard deduction. And I want us to kind of continue looking at this 1040. You'll see lines 12A and 12B, those get added and put onto 12C. And then there's a little line in the middle before we get to our taxable income, which is for qualified business income deduction. And I just wanted to point out that it's there, but it will require advanced certification, so we're not going to cover it in these trainings. So once we've taken out our deductions, we get to the end line of our page 1 of 1040, taxable income, which means we're ready to go on to page 2. And the very first line of page 2 is tax. Tax is another thing that TAXSLAYER is going to do the heavy lifting for us, but I just kind of want to make you aware of how it comes up with its calculations and kind of where the information comes from when you look at the IRS publications. So in the instructions for the 1040, and you'll probably notice our watermark again, these are from the draft publications for now. These are tax tables that if you were doing tax on paper, you would actually go into these into the instructions and look up the amount of income and figure it out with your filing status, and you would come up with your amount of tax based on your income, your taxable income from that last line on the front of the 1040. And I wanted to give you a little closer look at how the tax tables calculate the tax. Again, this is something that TAXSLAYER is going to do automatically for us, but I just wanted you to get to see the mechanics and be familiar with it. It's important to note that each filing status has its own tax table. So this tax table is for unmarried individuals who are not surviving spouses and not head of households. So these are taxpayers who are filing under the filing status of single. And you'll notice there on the left is if taxable income is, and we have some income ranges, and these are our tax brackets. And then on the right, we have a calculation, the tax is, and you'll notice that there's a base dollar amount, and then there's a percentage that is calculated on the amount of income over the lower portion of whatever tax bracket our taxpayer is in. So what you might also notice is that for our taxpayer who has a taxable income of $99.50 but not over the $45.25, the base amount is $995, which is 10% of $9,950. And if you'll look back at the previous tax bracket rate, that was 10%. So the way that our tax system is structured, it's called a progressive tax system. So we kind of have these layers of income that are taxed at certain rates. And so if somebody is in what we call, say, the 24% tax bracket, it's not their entire income that's taxed at 24%. It's just the layer of income that is over, in this case, $86,375. So they would have a layer that's taxed at 10%, a layer that's taxed at 12%, and a layer that's taxed at 22%, and so on. And that's what makes our tax system progressive. So now that we've had a chance to talk about the standard deduction and the computation of tax, which again, TAXSLAYER is going to do the heavy lifting on the calculations for us, but we are going to recognize when somebody might have a better tax deal if they can itemize and send them in the direction of a advanced certified volunteer. Here's what I want you to do. Head on over to Link and Learn and answer the skills check questions. There's just 2 of them this time. And then in TAXSLAYER, go ahead and enter charitable contributions into the appropriate practice return. As always, we have our publications 4012 and 4491. And I have great news. The IRS has now updated those for 2021 returns. So it will have everything current to current tax law changes, which in our next lesson, where we cover credits for children and other dependents, we're going to start running into a lot more of these changes. Up till now, things have been pretty static with the tax law has kind of stayed the same, but in our next lesson is exciting, and we get to learn about some of the changes and the shifting nature of tax. So we'll see you next time.